Singapore REITs are a popular choice for investors because of their attractive income distributions and stability. The REIT sector is seeing more green shoots in recent months as expectations of an interest rate cut rise. Many REIT managers are relieved to know that finance costs should ease once interest rates start to decline. Distributions should also start to recover as interest costs moderate over time. Meanwhile, optimism is pushing the unit prices of several Singapore REITs to new 52-week highs. Which are the S-REITs do we think have the highest potential for both capital and dividend growth? Hello everyone, welcome back to SDA Club, the club for stock trading and analysis. This channel is dedicated to providing you with high-quality tutorials, guides and insights that demystify the world of trading. Join us as we will share more trading secrets and valuable insights. To stay updated and to be the first to access these valuable resources, hit the subscribe button now. By subscribing, you're opening the door to a world of trading and maximizing your potential for success. Before we dive in, here is a quick disclaimer. The information in this video is for educational purposes only. It's not a call to buy or sell. So, why are REITs generally affected by interest rate movements? When interest rates fall, REITs benefit from cheaper financing costs, more sustainable dividend yields, and higher valuations as their distributions become more attractive compared to alternatives such as government bonds. Already, in today's environment, we are seeing low interest rate yields for many newly issued government and corporate bonds, with yields below 2%. The universe of investment assets that offer high stable yields in Singapore becomes scarce, and investors start to chase assets such as REITs, pushing its prices up. Despite latest data released in the US pointing to an acceleration in consumer price increases and further weakening in the labour market, the Federal Reserve have finally cut its interest rates. This 0.25% interest rate cut could have further fueled the Singapore REIT market into a rally. So can the rally continue? And which Singapore REITs do we see as the most promising? The IH S-REIT Leaders Index ETF rose 5.41% to 77.9 cents in the past month, as at the close of 18th of September. However, this is still far away from its 52-week high of 83.6 cents. The latest financial results for major S-REITs have reinforced the attractiveness of Singapore's REIT sector, with most trusts maintaining high occupancy, demonstrating resilience in operating metrics, and benefiting from declining financing costs. While some trusts face operational headwinds, the overall sector fundamentals remain solid, and the outlook is positive for investors seeking stable income and long-term growth. Therefore, there could be a possibility that the rally towards its 52-week highs for the IH S-REIT Index could continue. We select the top 3 REITs we identify as the most promising in terms of financial strength and distribution growth. They are Keppel DC REIT, a Singapore-based data center REIT with a portfolio of 24 data centers across 10 countries and assets under management of approximately $5 billion. Keppel DC REIT delivered a 12.8% year-on-year increase in its distribution per unit for 2025's first half to 5.1 cents, giving it a dividend yield of 4.2%, backed by a strong operational performance. With record revenues of $219 million, we could see continued resilience as the demand for data centers continue to grow, pursuing third-party acquisitions in Japan, South Korea and Europe, focusing on hyperscale data centers. The next is Mapletree Industrial Trust, a Singapore-listed REIT with 140 properties across Singapore, North America and Japan. Mapletree Industrial Trust manages $9 billion in assets, also comprising of data centers, high-tech business space, and general industrial buildings. The REIT's portfolio maintained overall occupancy at 91.4%, with its Singapore properties leading at 92.6% occupancy and Japan properties remain fully occupied, while North America data centers stood at 88%. MIT's Singapore portfolio achieved robust rental reversions of 8.2% for renewal leases, with general industrial buildings recording a 9.5% and high-tech buildings at 5%. Mapletree Industrial Trust delivered a distribution per unit for 2025's first half of 3.3 cents, giving it a dividend yield of 6.2%, backed by a strong operational performance with a revenue of 174 million Singapore dollars. Mapletree Industrial Trust remains one of the largest industrial REIT in Singapore, with a resilient and robust portfolio of diversified properties, making it a good grade REIT investment to consider. Finally, Parkway Life REIT. Parkway Life REIT is one of Asia's largest listed healthcare REIT. Parkway Life REIT owns a diverse portfolio of 75 properties across Singapore, Japan, France and Malaysia, valued at $2.46 billion as of 30 June 2025. The REIT delivered a commendable set of results for the first half of 2025, reporting a 8.1% year-on-year climb to $82 million, while net profit increased by 8% to $40 million. The REIT's distribution per unit for the period grew 1.5% year-on-year to 7.7 cents, giving it a dividend yield of 3.5%. Parkway REIT's Singapore hospitals are poised for a significant boost under the renewed 20.4-year master lease agreement running until 31st December 2042, which will see rental income jump 24% year-on-year to 99 million in 2026. This should translate to impressive DPU growth. For more information on how you can optimize your portfolio and would like to seek advice on your current investment portfolio, speak to us by replying to the WhatsApp link in the comment section below, and our team can provide a personal touch and talk to you about your investment plans. I hope you've gained some new insights on the Singapore REIT market from this video and could consider allocating some funds into this sector to ride the growth potential. See you in my next video. Goodbye.